All right, welcome to the third day of lesson. So today we're going to be going through market structure. All right, this is extremely important. If we look at our trading plan, market structure falls into the first part of the plan, which is trend bias. So market structure helps us identify whether we want to long or short, right? Is the price going up or down, or is it going sideways? And it helps us determine what is the best probability. Okay, which direction should we trade? If you're always asking, is the price bullish? Is it bearish? Is it going up? Is it going down? Watch this video, because at the end of this video, you'll be able to determine by yourself whether price is going up or down. Okay, so this helps us identify which direction to trade, which has the better probability, right? This is the backbone of all trading. So a few things we're going to be talking about. We're going to be looking at the two types of market structure. Then we're going to be identifying the structure, including impulse, retracements, break of structures, and change of characters. Then we're going to be looking at multiple time frame alignment and practical use of market structure. All right, so let's get started. First, let's look at the two types of market phases. So very simply, I've opened up the chart here. And there's two types of market phases. We either have trending or sideways. Yeah, trending or sideways. So in a trending market, you will be able to determine a direction very, very easily. Yeah, whether it's going up or whether it's going down. You look at it and you immediately know this is a trending market. It's going up. Or this is a trending market. It's going down. Very, very clear. Then you have sideways markets, which are very messy. You look at the chart and you can't really tell. Is it up? Is it down? 70% of the time, the market will be in a sideways range. Okay, so if you don't see a clear trend, most likely, or it's probably sideways. And the market is always sideways because of a thing called fair value. So buyers and sellers are always looking for fair value, where the buyers and sellers agree to a certain price. If the market is trending in one direction, that means that either the buyers or the sellers are currently stronger than the other side. Right? In the case of an uptrend, that means the buyers are stronger. In the case of a downtrend, that means the sellers are stronger. There's no balance. There's no fair value. They can't agree on a price. But when the market enters a sideways consolidation, that's when buyers and sellers agree to a certain price and the price becomes more stable, sideways. So that is the fair value that price has, where buyers and sellers have found a balance. Okay, so those are the two types of market phases. We have trending and we have sideways. Very simple. Okay, now let's identify every single part of this market, right? Every single part of this market. So in an uptrend, we have, or in a trend, we have what you call highs and we have what you call lows. Okay, we have highs and we have lows. Right, these are the points, right? Like the pivot levels here. The pivot where the market pivots, pivot. These are the highs and lows. In an uptrend, you always want to see higher highs and you always want to see higher lows, right? You always want to see higher highs and higher lows in an uptrend, because that means the market keeps going higher and higher, right? Higher and higher and higher. The lows get higher, the highs get higher. Okay? In an uptrend, you want to see that the lows are able to hold. Okay? In a downtrend, you have your high and you have your lows, and then you have your lower highs, and you have your lower lows. So in a downtrend, your lows always get broken, broken, and the highs hold. Okay, it's the opposite of an uptrend. In an uptrend, the highs always get broken to create higher highs, and the lows hold. Okay, so this is the general these are the pivot levels in a trend. The higher highs and the higher lows in an uptrend, the lower highs and the lower lows in a downtrend. Okay, in a sideways trend, we usually have highs and lows, but it's very hard to determine whether they are higher highs or higher lows. And because one moment you have a higher high, next moment you have a lower low, so the trend is not clear, right? In a trending market, you will see higher highs and higher lows very clearly, or lower highs and lower lows very clearly. You're able to look at it and identify it immediately. Okay, so next let's talk about impulse retracements, break of structures, and change of characters. Okay, so we've identified these pivot levels, right? The highs and the lows. After each pivot, we have these moves. So you see, after the high is created, we have this move here, right? We get a higher high, we have this move here, then we have this move here, and it just continues like that, right? It just continues like that. Yeah. So these have names too, right? This is what we call impulse. In an uptrend, the impulse is what creates the higher highs. In a downtrend, the impulse is what creates the lower lows. Okay, so the impulse is the move that continues the trend, right? After an impulse, we have this move here that goes in the opposite direction of the trend. This is what we call a retracement or a pullback, right? Pullback. Let me just write pullback. We have a pullback. Okay, so the pullback is the shorter move that goes in the opposite direction, right? Pullback. Okay, all right, so impulse is the continuation of the trend. Pullback is the retracement of the trend. Okay, now after each impulse, or each impulse has to break the previous structure, right? Because we want the impulse to create the new high or the new low. Okay, the impulse must break. In an uptrend, the impulse must break the previous high. In a downtrend, the impulse must break the previous low. Okay, these breaks, right, are what we call BOS, or break of structure. Break of structure. Okay, break of structure. Right, break of structure. Okay, so the break of structure creates the new high in an uptrend. The break of structure creates the new low in a downtrend. Okay, so an impulsive move in a trend is usually what we want to catch, right? In a trending market, it's best to follow the trend, right? In an uptrend, ideally, we want to look for long positions. We want to follow the trend, right? And usually we want to catch these impulse moves, because impulse moves are usually the strong moves, the big moves up that break structure. So this is where all the volume comes in. This is where we can make the most profit. Okay, we're going to try and catch these impulse moves. Okay, in a downtrend, same thing. We want to catch these impulse moves to continue the trend lower, to break the structure, create a new low, continue lower and lower and lower. Okay, so the probability is that in a trending market, we want to follow the trend. That is the best probability that we can take. Right? In a sideways market, on the other hand, we can either trade it either way. Right? We can trade it either way. But it takes more skill because sideways markets can get quite messy. I will be showing you guys my strategy for trading sideways markets at the end of this course, because it is a little bit more advanced, right? But for now, what you need to know that the best thing you can do is to trade with the trend. Okay, that is the best probability that you can do. Trade with the trend. Remember, if we go back to our trading plan, market structure helps us identify the trend bias. Do we want to long or short? What is the best probability? Yeah. Once we've identified market structure, then we know what action do we need to take. Do we need to look for longs? Do we need to look for shorts? Which is the best? Or do we just sit back and relax? If the trend is not clear, you can sit back and relax. You don't have to do anything. Right? But this is why market structure is very important, because it gives you a clear idea of which direction you want to trade in, or whether you should just not do anything. Okay, so we've gone through two types of market phases, right? Sideways or trending. We've identified the structure, yeah, our higher lows and higher highs, our lower lows and lower highs, right? We've identified impulse and retracements. Yeah, impulse meaning the continuation move in a trend that breaks the structure, and a retracement, which is the pullback or the opposite move in a trend. In an uptrend, a pullback is when it moves down. In a downtrend, a pullback is when it moves up. Okay, this is more of a temporary move, you know what I mean? Yeah, so impulse and retracements. And we've identified break of structures, which is when an impulse creates a new higher high in an uptrend. It breaks the previous high. This is a break of structure. In a downtrend, the impulse breaks the previous low to create a lower low. This is a break of structure. Now, finally, let's talk about change of characters. Right? Change of characters. Before we get into multiple time frame alignment, let's talk about change of characters. So change of characters is when, change of characters is when this happens. Okay, remember I said in an uptrend, we want the highs to break, right? And we want the lows to hold. Yeah, because in an uptrend, we need the floor to support us. We need the floor to hold us up, to keep us going higher. Yeah, but what happens when suddenly the floor breaks? The low is broken. Instead of a high being broken, right? Instead of a high being broken, the low gets broken. Boom. This is what you call a ChoCh, or a change of character. Okay, this signifies that the probability of the market changing characteristic from an uptrend to a downtrend has just become more likely. Yeah, because remember, in a downtrend, we want the lows to get broken. Yeah, low is broken, create a new low. Low is broken, create a new low. Yeah, that is a downtrend. In a downtrend, we want the highs to hold. Yeah, we need a ceiling to keep pushing us down. The ceiling must keep pushing us down in a downtrend. Okay, but what happens when suddenly that ceiling is broken? prap. Yeah, instead of a new low, new low, new low, new low, instead of a new low, suddenly the ceiling gets broken. This is also a change of character, because the possibility of the trend changing from a downtrend to an uptrend has just become more likely. Change of character. Okay, so a change of character is basically in an uptrend, when the low gets broken, in a downtrend, when the high gets broken. Okay, this is a change of character, right? Uptrend, the floor is holding, boom, suddenly the floor breaks, price can dump. In a downtrend, the ceiling is holding, boom, suddenly the ceiling breaks, the price has nothing to hold it down, it can fly up. Okay, so this is a change of character, but this change of character is not always so perfect like this, right? You won't always see it so perfect. Usually what happens is, after a trending market, there will be a sideways phase. That is when the change of character happens. Boom, break here, change of character. Yeah, it's not always so clean, just boom, suddenly like that. There's usually a consolidation and then the change of character happens. Or from a downtrend, consolidation, boom, change of character happens. Okay, usually after a trending market, there's a change of character. Before a trending market, there's also a change of character. Yeah, like I said, most of the time the market is in a sideways phase. Yeah, so before and after a trending market, there's a sideways phase, and usually there's a change of character, right? There could also be a trending market, sideways phase, and a continuation. Yeah, trending market, sideways phase, and a continuation. So not necessarily is it always a trending market, sideways, and then a change of character. It could be trending market, sideways, continuation. But before and after every trend, there's always a sideways. Yeah, the price doesn't always go up forever and ever and ever. It doesn't always go down forever and ever and ever. There's always a consolidation somewhere in between, because the market needs to rest, right? The market needs to rest. Okay, so at this point, we've talked about the two types of market phases, sorry. We've identified the structure, higher highs and higher lows, lower highs and lower lows. We talked about the impulse and retracements, and we talked about break of structure and change of character. Now let's take a look at multiple time frame alignment. Yeah, how do we align the time frames? Okay, now you may get, or when you ask someone, right, is price going up or down? Half of the time, some people will say it's going up. Half of the time, some people will say it's going down. And they're both right. Yeah, because it really depends on what time frame they are looking at. If you take a look up here, you can see that there are so many time frames. Okay, so it really depends what time frame you want to trade on. Okay, and the key rule is that you need to find one time frame where you want to execute your trades on, and then you need one time frame higher to get your bigger picture, to get that time frame alignment. Okay, so for example, if we're trading on 1 minute or let's say 5 minutes, we want to look at the 1 hour time frame. Okay, if we're trading on 15 minutes, yeah, then we want to look at I would say 1 hour or 4-hour time frame. If we're trading on the 1 hour time frame, then we want to look at 4-hour or even the 1 day time frame. If we're trading on the 4-hour time frame, then we want to look at the 1 day or even 1 week time frame. And if we're trading on the 1 day time frame, then we want to look at the 1 week or 1 month time frame. Okay, so smaller time frame is usually where you look for your trade or you look for your entries, where you execute your trades. Higher time frame is where you get that alignment. Okay, what do I mean by alignment? Let me show you. So let's say you see right now, let's say we're trading the 15-minute time frame, right? We're trading the 15-minute time frame. We see it's a downtrend, right? We see it's a downtrend. So we want to short this right here, right? We want to follow the trend. Yeah, we want to short it right here. But what happens? What happens if we zoom out and then we see that this downtrend is actually a temporary move in an uptrend, right? In a higher time frame uptrend. Yeah, that means this downtrend on the lower time frame is temporary. Not that we can't trade it, we can, but you have to understand that the probability of you making profit is lower as compared to if you wait for the lower time frame to also get in alignment with the higher time frame. Yeah, once you have multiple time frames in alignment, your probability of making profit is much higher because you're catching the move not only on the lower time frame, but the probability of you riding this higher time frame trend and making a much bigger profit is there. It could happen, right? So the probability of you making more profit is much higher when you have alignment from your lower time frame to your higher time frame. You get what I mean? Just now I said that ideally, most of the time, the best, we want to try and catch the impulsive moves, right? The moves that break structure and continue the trend. We want to try and catch these moves because these are the big moves. This is where the volume comes in because we're breaking the structure, we're continuing the trend, and the possibility of going higher or going lower, right, is there. The probability is much higher. So we want to catch these impulsive moves. So if you're on a if you're looking for a long position, right, you want to make sure that your lower time frame aligns with your higher time frame. So ideally we want to wait for that change of character on the lower time frame and then trade it up with the higher time frame. This is where we get that alignment. You know what I mean? Yeah, we want to get that alignment. Okay, same thing if we're in a downtrend on the higher time frame. Yeah, if we're in a downtrend on the higher time frame, we want to get that alignment. So instead of trading this uptrend, wait for that change of character, wait for the lower time frame to align with the higher time frame and then get in on this impulsive move. The probability of making profit, making a bigger profit, is much higher, right? Because we have lower time frame and higher time frame alignment. Okay, so this is why it's very, very important to have at least 2 time frames. Yeah, one lower time frame where you execute your trades on, one higher time frame where you look at for the bigger picture to get that alignment, just to know that where are we currently at in the market. Are we currently at retracement, or are we currently at the end of an impulsive move? Yeah, so that you know, is it the best time to enter or not? Okay, if you're in an uptrend and then you see that we are at the end of an impulsive move, then you wait, right? You wait for the retracement, because this will be the best time to get in on the trend and try and catch that next impulsive move. Yeah, so this gives you the ability to look at the bigger picture and look at where you are currently at on the higher time frame. Okay, same thing if we are in a sideways market, right? Let's say we are in, it looks like we are in an uptrend, right? It looks like we're in an uptrend, but on the higher time frame, what if we are in a sideways market, right? You don't want to be trading it up into the top of the range, right, where there could be a reversal. You don't want to be taking a long position here. Yeah, because the market is sideways, it could just flip, boom, go back down. Yeah, so you want to be able to tell, where are you at in the market? Is it a good time to enter or not? So this is the power of multiple time frame alignment. Okay, so I hope this gave you some clarity, yeah, on the power of trend bias, being able to identify the market structure. This helps you determine the best probability. Should you long or should you short? Yeah, where are you currently sitting in the market? Is it a high probability area or not? And this helps you identify which direction you want to trade, or whether you should just sit back and wait for a clearer trend. Okay, so this is trend bias, market structure, which falls into the trend bias category of our trading plan. So in the next video, we're going to be talking about zones. Okay, and we're going to be looking at all of these very fun stuff to help us identify our zones. And zones is basically where we determine the best place to enter a trade. All right, so make sure you guys watch the next video. I'll see you guys in the next video. If you guys have any questions, feel free to chat in the group. That's all for this video. See you guys in the next one.